Hello everyone, today is Friday, April 15th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. We are back in action, a rare miss last week. We did not get a video published, but we are here. It is the long weekend. Happy Good Friday. Markets are closed today. We've got the long weekend. We've got a lot to discuss in this week's video, so let's catch up here. If it's your first time tuning in, welcome. Thanks for joining us. Thanks for being here. Here's how we sort of break up these videos and our weekly market analysis. We split things up into two parts. In part one, we look at everything that went on this week in markets. We go beyond price action. We look at things like market internals and volatility, the term structure, interest rates, commodities, sector performance, all the good stuff, pick apart things that stand out, look different or interesting. And then in part two, we jump into those charts. We look at those longer term trends. We've got a couple of specific charts I want to go through today. So including price action, we've got oil and gold charts I want to highlight. I've got credit markets I want to go over, and then we can look at our sectors and industries that are making some notable moves. So hopefully that sounds good. Let's jump into some of the headlines from this short trading week. The top of the sort of story for me is the US dollar is still relentless on its path higher, and so are interest rates. US Treasury yields continue to tick up and up. We are hitting new multi-year highs basically in both aspects here, the dollar and Treasury yields. And as far as I'm concerned, we're not going to see a sustained rally until we can get those markets to let up at least a little bit, to pull back, to stabilize, to go sideways. And so long as those continue to march higher, I do think equity markets will continue to see that pressure. It does feel like in the TLT, I tweeted this out on Friday, it does feel like we're getting to some sort of capitulative short-term state. We can talk a little bit more about that in part two. We've got gold breaking out to multi-week highs. That is encouraging, and we're finally starting to see that consolidation resolve higher. And then credit ETFs. So we're looking at the high-yield credit markets, junk credit markets. These are still, again, in this camp that just suggests things aren't that rosy and pretty out there because they continue to hit new lows. We'll talk about that later as well. So if we take a look here at the numbers on the week here, it's this right-hand column. You can see certainly a negative week. I mean, I guess a bit mixed. The Russell 2000 managed to stay positive here, 0.5% to the upside. But take a look at the Nasdaq, down 3%. So really getting clobbered. S&P 500 behind it at 2% down, and the Dow Jones almost 1% down. So relatively, or as a whole here, U.S. markets certainly getting attacked this week, and then world stocks here also down 1.23%. So faring a little bit better, but still, nothing too exciting there for performance. If we take a look here at our equity market grid, so this is our smart trend filter indicator here. These are the multicolored dots. It's just an objective way to measure trend, and it is available for TC2000 users and TradingView users. If you want to get this, you can get it on our website. And you can see here that we do have the S&P 500 back below our weekly smart trend filter. So we're still in this yellow transition state, but we did get a sell signal here a couple weeks ago. Same thing for the Qs. We're back below our smart trend filter in the yellow transition state. Russell 2000 and ACWX. So basically here we are in a negative state where the prior signal was a bear sell signal, and we are now back below the smart trend filter, which indicates to us that we could flip back down and just continue this ride lower. Now, there are some short-term exhaustion signals. This is a bigger picture, so weekly chart. But objectively here, if you're just taking a very simple approach, what does price and volume tell me about the market over a couple of month period? This is all you need to know to say this might not be the market I want to be investing in right now. Now, if we take a look at market internals here again, top row is NYSE 52-week highs minus lows. You can see just red across the board, triple digits across each day, minus 800 for the week. So lots more stocks in aggregate hitting 52-week lows. AD line as well, negative on the week, although trying to fare a little bit better. That's that small cap resilience. And if we look at the number of stocks above 20 SMA here in the S&P 500, about 44%. So we've actually got room to go lower, but it is trying to, kind of hold its ground a little bit. If we take a look at those market internals again, you can see just in summary here over the past 30 days, this is the downtrend that we've been experiencing here on a cumulative basis for 52-week highs minus lows. This trend remains down. Remember, we had this period in here of about a week where we sort of just went sideways. That was that big rally off of the lows where the market was essentially, screaming higher, but we didn't quite see anything that encouraging in this view here. And this is why market internals on this broader measure is one of my favorite views, because it helps sniffing out, what's a real move, what's not, and sort of where the money flow sort of is. So market internals continue to drip lower. Volatility here, not a big change, given the fact that markets did close down a couple of percent this week. We didn't really see that much of a change here in VIX. So we've got the front month VIX still around 2270, so it's staying in the lower 20s. This is obviously elevated from a historical basis, but it's nowhere near the 30 plus levels that we were back in February and early March. So we still have a relatively steep term structure here for volatility, but it's not screaming back up to those 30s right now. If we take a look at sector performance here, you can see again, most things in the red, but there were some things working this week. We had materials at the top of the list, energy and industrials. They were basically all up about 0.5% or so. Those were your top three standouts. You also had consumer staples, which managed to close green. But on the downside, it was technology. Technology got hit pretty hard here this week, almost 4% lower. Healthcare at 3%, financials at 2.6%. And yes, by the way, we are moving into earnings season. We did start to get some of those financials reporting. So, we are getting the early sort of look at how the market is reacting to those financial stocks, to interest rate environments, and earnings expectations. Now, interest rates, as we just mentioned here, we're back on the rise. You can see again, green across the board, across the term structure here. 1 month numbers, bright green. 1 year numbers, all very bright green here. So this is definitely driving the narrative. And of course, we've got the credit markets here, which LQD and JNK, both of these negative and both hitting or pretty close to 52-week lows, multi-year lows, and that continues to be a problem, as we sort of highlighted at the top of the video. If we look at the dollar here, this was also up, breaking to new highs. You can see the 1 month and the 1 year also very strong here for the dollar. But gold did rally. We actually had a pretty positive week here in terms of commodities, which again is typically not the general correlation that you see. Usually dollar up, commodities down, vice versa. But commodities, again, inflation and everything else that's driving the current flows here are sort of unique in this situation. And we are seeing commodities back on the rise across the board. Lastly here, if we look at correlations, you can see correlations still bright green here on this top left quadrant. And we talked about this. This is usually what you'll see during the high stress, high risk, very volatile market environments, is you've got all risk assets that basically get treated the same and money goes from risk on to risk off. Take a look at the UUP correlation here. Look how bright inversely correlated the dollar is to the equity markets as a whole. This is also why I have a very strong opinion in the fact that we need to see the dollar kind of pull back and just retreat a little bit if we're going to get some type of sustained equity market rally. So these are some pretty bright correlations that are happening here. Obviously, you can see TLT as well has some nice, strong inverse correlations to what equity markets are doing. Now, if we wrap it up here with our allocations, with our trading systems, we've got 2 trading systems we run here at Trade Risk. They're fully rules-based. They're quantitative. They run without my judgment. They are hard-coded and sort of act on their own. Our longer-term system, it actually just picked up some more exposure, a little bit of exposure here, first buy signal in a while on Friday. but it's still mostly cash. I mean, it's 35% invested, so this is not an aggressive long sort of positioning right here. And our short-term strategy is starting to tilt more to the long side here as well. This has been short for the most part. It has been, rotating in and out of short trades, but over the past few days, this is also now starting to ratchet up its long exposure. And you can see, again, not a very aggressive stance, 24% invested across 7 positions. That's a mixture of shorts and longs. So that's currently how we're positioned right now. These are 2 trading systems that we do have subscriptions for. Again, if you want to get nightly reports, if you want to stay up to date with what they're doing, take the $1 trial on our website. You can learn more about them, see if they're a good fit for you. So that's it on part 1. We'll be back here in just a second with some charts. All right, we are back. We've got TC 2000 open here, and we are going to jump right into some price action analysis on the S&P 500. So we've got a daily candlestick chart we're showing right now, and we can see that the S&P 500 over the past, let's call it a week and a half, 2 weeks at this point, has been on the decline. Now, this follows this rip-roaring rally that we had off of the lows here. So that third week in March, we basically started this rally here from 4,200 all the way up to 4,600. That was 10.5% in the S&P 500, basically in a straight line over a week and a half period. If you recall, so we did not get a video out last week, but our prior video was on this, let's see, this Friday right here. So we're on this session right here. And the call out for that video was the headline for that video was that the markets failed to hold above the February highs. That was the most relevant sort of information we had at that point, was the fact that we got these big long tails here on these weekly charts in the S&P 500, in the Nasdaq, right across the board, basically, individual stocks as well. And so the fact that we failed at that February highs put us on alert for follow through lower. We needed to see that follow through to the downside to give us that proof, that evidence that yes, in fact, the market is topped off. And we got that. We saw follow through on last week, and then we saw more follow through this week. So when I very simply, and I just want to look at this at a high level, when I take a step back and try and not overanalyze this market, then I start to just frame things out very, very broadly like this, right? This is a very wide trading range now that we've been in pretty much year to date. I mean, obviously we started the year at highs, but we quickly, just sold off coming into the beginning of the year. And 80, 90, 95% of our trading has taken place in between 4,200 and 4,600. So this is where the market's comfortable playing right now. It's just oscillating in a very wide range, and lots of price action, lots of emotions, and lots of buyers and sellers are coming to a meet in this general zone here. So when I look at this a little bit closer, right, that's the big picture. So if I'm only caring about the big picture, then I'm only caring about some type of resolve over 4,600 or breakdown below 4,200 to give me my more meaningful move, right? Like that could be a very simple framework or view on how you can think about this market. Now, if you want to look at things a little bit tighter, well, we're back to the middle of this range here, and you could throw on, some fibs here. You could look at the retracement from the lows in March to the highs up here, and you could say, okay, we're probably about 40-50% retraced at this point. This is kind of where you'd expect buyers to maybe show back up. But if you're bullish here, you're really looking for some type of higher low. You don't want to see us just roll back over all the way back down to 4,200. That wouldn't be too productive. You'd want to see us try and chisel out some type of higher low and bounce us back up towards the upper range. That is the ideal bullish case scenario at this time. We don't have a whole lot else to really kind of hang our hat on. Obviously, you can draw, just this general sort of channel, this trend line that we've been falling in. So, okay, again, you've just got more reference points. If we can start, breaking out from here, then maybe we've got a trade and a move back up to test 4,600. I know I see a lot of people sort of looking at, maybe some type of what could this be? Some type of inverted, head and shoulders pattern. That's all fine and well. I don't really look at markets like that, but I know some people are sort of, putting these, I can't get that now. Let's see, put, something like this, and, then we can break out from this, and that's all fine. But basically, we want to see some type of higher low here, but I think broadly speaking, this is the range, and then you can look a little bit tighter at this price action. If we look at something like the IWM, again, this one here is just moving much tighter, and this is something this is not new. We've been talking about this. The Russell was the first to break down. It's the first to start to stabilize, but as we always sort of go back, this is a pretty horrendous view. I mean, if you saw this in a textbook, you're probably not going to be an excited buyer here with all of this overhead supply from a year and a half of trading and then a recent breakdown below it. So this could morph into, right, this would be the super pessimistic view, is if the Russell 2000 just sort of creates this multi-month bear flag, right? And this was the initial breakdown, and you've got this big, kind of second leg wave coming on a trigger below 190, right? Like that would be pretty horrible here, and that would get you probably back down to the 160s. It would totally evaporate the COVID, rally trade and come back down to the old highs. So that's a possibility here, right? Like this has not been negated. In fact, this is sort of path of least resistance on a longer term basis. On the shorter term, though, we've got the Russell. We failed to push back over this bottom end of this old range that it broke down from, and now we're kind of hanging out here. So let's pay attention to the Russell. It held up this week, but if this starts losing the 192s or so, look out below, because that looks pretty scary if we start breaking down from that range. Last but not least, the Nasdaq 100 here. Again, this is just very wide, very sort of sloppy. I know there's been a lot of people kind of looking at this as, once again, trying to do some type of head and shoulders or whatever, inverted. That, again, that's fine. We want to see a higher low. We don't want to see it come back down to 320. Basically, everything we talked about for the S&P 500 pretty much applies here as well. So that's the read there on the price action from a candlestick perspective. Again, we sort of talked about, or we did talk about the trends here on the longer term basis. So again, we know what the trends are, we know what we're looking at, and things are a little bit bleak right now in terms of a price and volume perspective on a trending basis. So let's look at some other charts. I wanted to look at oil first. So oil USO here, again, you can see this consolidation is still taking place. So we've basically now moved sideways since the start of March. We topped out around $80, $86, that is, in the USO. That's not the price of crude oil barrel per WTI per barrel. That is just this USO ETF. But we topped out around $86. We've been going sideways here. I mean, it's starting to look pretty constructive in the sense of we're just kind of working off this epic run higher, and now we're moving back up to the range. I don't know that it's ready yet. I would still give it more time. I don't have a position here in USO, but it is consolidating. You want to see this just continue to take its time and get ready. But this is kind of what we're looking at. You can get a little bit tighter on some of these levels, but I think the picture there is still pretty clear. If we take a look at GLD, you can see gold here on a weekly basis just kind of paints the picture a little bit. Kind of a similar situation, right? We had this very strong run up in the first start of the year, basically from 165 all the way up to about 193. So then 5 weeks time, gold going 15%. That's a pretty big move. And now for the next 5 weeks, we've gone down to flat to sideways to nowhere. But we're starting to lift up right here. So you can see we're starting to clear above these multi-week lows. We got a new weekly closing high, pretty low volume, but still heading in the right direction here. So GLD, like it, I have some, and we'll see if this can continue to rally from this point. I also want to talk about credit markets. So LQD. So this is investment grade credit markets. LQD, this looks horrible, as the S&P 500, for instance, stays up here. That's not the S&P 500. As the S&P 500 is still 5-6% off of its highs. It's kind of hanging out in the middle of its range. We have the LQD, which is just hitting new lows, and this just goes to show you of kind of what credit markets are doing and how they're functioning. And you can see LQD. I mean, you can look at JNK, right? These are markets that are in pretty steep downtrends and continue to hit new lows. again, concern here for just the broad sense of things. Also, TLT. So I do want to just talk about this because, TLT, again, when we talk about interest rates, TLT is the opposite. It's the inverse. It's the bond fund for interest rates. So again, interest rates go up, bonds go down. And the TLT here is getting pretty steep, so it is getting pretty oversold. I was doing some different studies on this. I don't have anything available to show you right now, but I was going back in time, and this is a pretty severe downtrend that we've been experiencing here, and it is very very much oversold on lots of different metrics. So I wouldn't be surprised if we get some type of washout here soon, and maybe we even saw it on Friday. Maybe there's one more epic puke on Monday, and then some type of strong reversal. I don't know that it's the bottom. It could just be a short-term bottom. I still wouldn't bet against this big downtrend, but I think tactical traders might look for some type of quick reflex bounce here maybe in the coming days. That's just more so my spidey sense than anything else. So I think that's everything in terms of charts. Let's wrap it up here with some sectors and industries. We actually got an even mix here. So this scan's available. It's on our website now. So this is our sector and industry layout scan. This basically shows us, what sectors, what industries are making notable moves. So if we look on the upside here, we got agriculture breaking out to new highs. So again, lousy week out there in the markets. But if we look at ag inputs, you can see that this is closing at new highs. You can click this little box here in TC 2000 and you can see all the individual stocks that make up this very strong industry right now. So you can, kind of have fun picking strong stocks, strong sectors. Department stores breaking out or trying to break out here to new highs. That's interesting. That's notable. I did not know that until I looked at this. Energy. Okay, that makes a little more sense. Oil and gas drilling, oil and gas equipment services. And last but not least, silver, some of the basic materials here breaking out to new highs. Now on the downside, we got financial services. We got banks closing at new lows here. Pretty low volume, but again, closing at new multi-month lows. We've got technology, a few here. So communication equipment specifically. Remember, technology had a pretty poor week. Here's a specific industry equipment that is breaking down here from this, this weak kind of rally attempt. This looks pretty poor in here. Computer systems breaking to new multi-month lows. Medical instruments and supplies. This is also heavy volume, kind of reversing back down towards lows. Semiconductor equipment, again, breaking down multi-month lows. And then just the SMH outright. So this is just the broad-based vectors. Semiconductors, ETF, and this here is closing at new lows. So that's it. That's the sort of wrap up for this week. Lots of, sort of pain out there, generally speaking. Sentiment is really lousy. Lots of people seem to, and for good reason, hate this market. But sentiment is, pretty much in the dumpster right now. That is the one thing that, again, tells me maybe we could get this quick reflex bounce here in some of the majors. Maybe we put in some type of low around here, get a bounce up to 455. And then, roll back over or sort of, dance around. So that could be, something that's in the cards. But right now, technicals, breadth, interest rates, credits, everything basically is giving you the warning signs or the bearish signals. So that is it for me. Thanks as always for tuning in and listening. Every Friday, if you like the video, please do subscribe to our YouTube channel, and you can always catch us at thetraderist.com. Have a great long weekend. We'll see you back here next week.